Sometimes we might have to sacrifice some of the upside to make sure that there's no downside. So a common example of that is the person that wants to achieve maybe a slightly unrealistic value for their business. And you can help them achieve that, but they have to work with you for you to pay them out of the business over a period of time. So what you might find is that you're buying a business for $500,000 that you could probably get for 300 grand in cash.
He wanted money.
Yep.
And he was insistent on wanting money, and you were insistent that you wouldn't or didn't have any to give.
Yeah.
And that it was going to be very low risk for you. I mean, how do you convince a vendor in that situation, to sell a business on those terms? Because I think everyone's initial expectation would be anyone who's prepared to sell a business for where they're taking all the risk in selling and receiving little money at the beginning. The business must be shit. It would be the natural expectation.
Yeah.
Because that as much as that guy may be desperate to sell his business, if he's actually making some money or he owns some assets, is he not better off just liquidating it rather than selling it to you, losing all control? You accidentally fuck it up or purposefully screw him, and he's got nowhere to turn.
Yeah, look, you're not going to buy Apple on that basis, but when you look at SME companies, they're all a bit shit, to be honest. If you look at any small to medium sized company, if they lose a couple of key staff or a couple of key customers, it's a game changer, and the whole thing can be done. The whole business can disappear. So you also have to look at the flip side of it as to where do you deploy capital, because effectively small businesses are an incredibly volatile asset class. I mean, like I say, the whole thing can evaporate in a moment. Amazon could do it for free, or Google could do it for free, and suddenly you have a massive problem in your industry. And so, they are very volatile assets. So by the same token, do you really want to be putting capital into a very volatile asset? And if you do put capital, what's the risk-weighted return you should expect from that capital? Because, there are, you can buy a 2-year treasury bond at the moment that will give you 5% a year, and there's loads of really good investments now because interest rates are rising. There's loads of really good investments now that will give you a low double-digit return. So when people talk about selling a small business and wanting 10 times earnings, well, 10 times earnings is 10% return on capital, but you're in a completely fucked up, illiquid, risky asset class. And so there is a dose of realization that small business owners need to have about fair pricing. And then the other dose of reality is about just the audience they have for their business. So if you look at $100 million plus enterprise value businesses, there is a large audience of potential buyers, private equity funds, SPACs that are sitting on cash. I think there's 3 trillion in PE at the moment looking for a home. So supply and demand economics, when there's lots of demand and not much supply, prices go up and it all looks wonderful. But as you move down the food chain, the audience gets smaller and smaller and smaller. And if you find a business that's doing 1 to 5 million in revenue, there are almost no buyers, almost no natural buyers in that space. There might be a couple of trade buyers that will go and pick stuff up, but equally they'll probably be looking at low money down or no money down type structures for acquiring those companies. And look, when there's low money down or no money down, it doesn't mean they're getting no money. It just means that the deal is going to be structured so they receive their money over a period of time. And what you're trying to create effectively is asymmetric risk, which is, as the buyer, you're protecting your downside but allowing upside. And if you think about it, if you went to a casino and every bet you made you can't lose, but you could win, you'd bet every penny in your pocket, wouldn't you? And that's effectively what we're trying to mimic. We're trying to create a scenario where the downside is protected, but the upside is still intact. And sometimes we might have to sacrifice some of the upside to make sure that there's no downside. So a common example of that is the person that wants to achieve maybe a slightly unrealistic value for their business. And you can help them achieve that, but they have to work with you for you to pay them out of the business over a period of time. So what you might find is that you're buying a business for $500,000 that you could probably get for 300 grand in cash. But in order for them to get the $500,000, they've got to work with you to get to that figure. And then from their perspective, the headline is more attractive to them. And if they believe that you can actually deliver on that stuff, or they believe they can put the security in place around it that that protects them, you can probably get that deal away. But every deal is different, and I mean we have many different deal structures that we use to approach people. Some of them we use, public companies where we issue bonds, and we use the bonds as consideration. So they actually have a regulated financial product that pays them money every month. So it's not like just give us the business and hope everything is okay. There's a firmer structure sitting behind it, but that's for bigger companies. But at that smaller end, it really is a buyer's market. There are not a lot of natural buyers for these businesses, and that gives us most of the strength in the negotiation.